It's by far the single biggest risk to the US economy and to the economic and financial system as a whole, not just in the US, but all over the world. And that risk is bank failures. And let's make this clear, bank failures are not something that's new. They've happened before, and they've led to significant economic crises, including the Great Depression. And guess what? They're going to happen again, whether it is because of lax lending, exposure to commercial lending, or exposure to bonds and long-term notes that basically lose all of their value and make the bank illiquid. But there's a few things that always happen right before a bank fails, and that's what I'm going to discuss in this video. And I'm going to talk about specifically how to protect yourself from those inevitable bank failures. But before I get into it, my name is Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit that subscribe button and hit that like button so more people like you can see this video. If, of course, at the end of this video, you found it useful, interesting, or insightful in any way, shape, or form. It really helps with the YouTube algorithm, and it helps this video and all the videos on my channel get seen by more people. Okay, so let's get into it. Let's discuss bank failures, how they happen, what you can look out for when it comes to monitoring your current banks, and how you can protect yourself from a bank failure just in case you do happen to find yourself in a position where the bank that you bank at and have all of your deposits actually fails. And I'm going to talk specifically about how to protect your deposits. I'm also going to talk about how to protect your securities, so your investments, and what you can do to minimize the risk just in case your bank does actually fail. So let's start by talking about why banks do in fact fail. And there's the obvious reasons, of course. There is the runs on the bank. But you have to keep in mind that the runs on the bank are often a symptom of a problem and not the actual problem itself. Because most of the time, people don't run to take all their money out of the bank when everything is normal. It is when the abnormal, unexpected events happen that people start to get scared and try to get their money back before they risk losing it. And like I said at the beginning of this video, there are some ways that you can protect your money so that you don't actually have to risk losing it. And the reality is they're very simple, they're very easy, and for the most part, you don't have to worry about your money when it's deposited in the bank if you take some simple steps to protect yourself, which I'll talk about in a little bit. But when we talk about the symptoms and then we talk about the causes, the symptoms is obviously the bank run. We saw this with SVB, we saw this with different banks throughout history, but the cause is typically something a lot more severe. The causes of bank failures include things like bad loans, which we saw in 2008 with all of the crazy mortgages that were given out where you could go and get a ninja mortgage, which was a no income, no job, no assets mortgage, which basically meant pretty much anybody could qualify for a mortgage. And that obviously led to defaults when people couldn't actually afford the mortgages that they had been given. It also includes things like the potential issue right now, which is the commercial lending exposure on all of those buildings that are underwater and that are basically getting walked away from by major investment corporations. Then there's the obvious things like loan defaults, which again goes back to 2008, but also to the 1920s prior to the Great Depression, when pretty much everyone was borrowing money to invest because the stock market only ever goes up. And of course, if you can borrow money and get greater returns, it obviously makes sense to borrow, doesn't it? Well, that type of thing often leads to massive defaults when the market turns and people don't have the money to actually pay back the loans. And then there's other things like economic conditions. Take, for example, like I said earlier, SVB, which basically found themselves in a situation where they had invested a significant amount of their assets into long-term bonds. And when the value of those bonds fell because interest rates had gone up, they had what was called unrealized losses. And when they started needing to pay back depositors, but couldn't get out of those long-term bonds, well, that created an issue that caused many of the companies that banked with SVB to go in and seek all of their money back from SVB. So in other words, they went to get all of their deposits back, and that caused a run on that bank. But the economic conditions were the primary cause of that issue. Of course, there's also the fact that they were invested in long-term bonds, and as a bank, they should have had a lot of short-term assets just in case there was a scenario where people would need to get their money out. But of course, they didn't do that, and the economic conditions combined with mismanagement led to the failure of essentially the biggest bank in history. Or I guess more specifically, for the word Nazis out there, it led to the biggest failure of a bank in history. But then there's other potential issues, and this isn't so common with big banks that have lots of profits, but is more common with small regional banks that run into things like insolvency and not having enough money to essentially pay the bills. That could be because of higher costs due to increased wages or maybe increased rents, or it could be lower returns on different types of investments, or it could be due to loan losses. Or in the case of SVB, it could be because they don't have enough liquid assets to cover the deposits when the depositors come running to the bank to get them out. Now, there are telltale signs of all of these potential issues, but they are hard to detect prior to them actually happening. Now, that being said, if you're sophisticated financially, there's a whole bunch of things that you can look at to determine whether or not your bank is in trouble. And there's all kinds of documents now as a result of the 2008 financial crisis and because of what happened with SVB that pretty much give you all the data you need to kind of get an indication of if your bank's in trouble. The problem is that all of these documents are super complicated to understand. For example, there's the Form 10K and the Form 10Q, which are annual and quarterly reports, which you can get from the SEC via their EDGAR database, which is their electronic data gathering, analysis, and retrieval database. Now, going in and actually finding them on the bank that you want is pretty easy, but opening them up and seeing all the data gets pretty complicated, especially when all of that data is written in accounting language, which is very, very hard to understand. Then on top of that, there's the FDIC call reports. Now you have to go to a site called the FFIEC to see these, but these call reports basically give an indication of what's going on with the bank on an annual basis. But again, it's a whole bunch of numbers that don't make a whole lot of sense. And I'll show you examples of these in a second so you can kind of understand what I'm saying here. And then there's the Uniform Bank Performance Report, which actually has some really good summaries of different ratios that give a pretty good indication of the health of the bank. But again, unless you know exactly what you're looking for, these become pretty hard to read. And I'll give you a little bit of a taste of what to look for, but understand that you can protect yourself from bank failures by taking a couple strategic steps. So going through all of these steps and trying to assess your bank are probably things that you don't really need to do unless you know for sure or you have some sort of feeling that your bank is actually in trouble. Now, another place you can go in order to assess the health of your bank is the bank credit rating agencies. These are companies like Moody's or DBS, which is run by Morningstar, or the Weiss ratings. And all of these different organizations will give you ratings based on the health of the bank. The higher the rating, the more healthy they are. The lower the rating, the less healthy they are. Now, when it comes to where you put your money, it probably makes sense to go ahead and put your money in the banks with the highest health ratings, the highest credit ratings. Just like a lender would lend to the people with the highest credit ratings, you should be thinking about that when you provide your deposits. But this isn't foolproof either, because when you look at companies like Lehman Brothers, who went under in 2008, it had one of the highest credit ratings that you could possibly get, and still the bank failed. And that was largely due to mass defaults by mortgage borrowers that couldn't qualify for their loans because of the aforementioned ninja loans. Now, to give you a taste of what a lot of these reports look like, this is an example of a Form 10K. Again, what you can see is this is complicated. There are lots of numbers, lots of things to pay attention to. If you are a banking expert and you understand the ratios and everything else, you can gain a lot from these reports. But if you aren't a banking expert or an accountant and you don't know what to look for, this is just a lot of noise. And then here's an example of a call report. Now, this is actually from a 74-page document that gives you all kinds of data on the banks. But keep in mind, this is a 74-page document, which means there's probably a lot more noise in these documents than there is data that a common person can understand. But I'll humor you for just a second and explain some of the things that you could look for in some of these reports. So one of the first things you can look for is the total capital ratio. And this is the total capital divided by the risk-weighted assets. Basically, what you never want to see is this number fall below 6%. Now, a lot of banks in the US run 15, 20, 30% on this number and are more than healthy. But if this number falls quite substantially, it can be a sign of major problems to come. Then there's things like the loan to deposit ratio. So the percentage of loans they have relative to the amount of deposits they have on hand. Now, typically anywhere in the range of 95 to 105% is pretty safe. But the higher this number goes, the worse the potential scenario is for the bank that you lend at. Because what it means, if that number is higher, is that they have lent out far more money than they have in deposits. And obviously, if they've lent that money out, it becomes very hard to pull it back and call the notes and reliably be able to collect it so that they can pay out the depositors. Then there's other things you can look at, like the non-current loans. So the loans that have missed payments of 30 days or greater. Obviously, the more loans that are in some form of default, the worse the situation is for the bank. And this is what we saw in 2008. All of a sudden, the number of non-current loans went through the roof, and that is when the bank started to realize that they had significant problems ahead. And when this became public knowledge, it started to create a significant problem in the US banking industry. And by the way, that is probably the number one key here is the point where a bank starts to fail is when potential issues, big or small, start to become known to the public. That is when people start to withdraw their funds, and that's what leads to a bank run. It is very much a sentiment-based issue. Whether it is a material issue or not is irrelevant, because if you have a whole bunch of people going to the bank to get their money and there isn't enough money to give to the amount of people that are trying to pull it out, it creates an issue whether that bank seemed like they were fine or not. By the way, when it comes to non-current loans, typically 6% is the worst that has ever been seen in history. When that number starts getting higher than 6%, gets up to that 10% range, that is a significant problem for a bank. Then there's other factors you can look at. For example, one that I just pulled out randomly here is the commercial loan sizes. So if a bank deals typically with very large companies, they're probably pretty safe and secure. But on the other hand, if the bank has the majority of its money lent out to very small businesses, well, this could potentially be a problem, because it is the small businesses that tend to fail first. So when a recession comes along and there's all these small businesses that owe a bunch of money, and they're the ones that don't have the resources to keep going during the bad times, well, that obviously leads to major problems for a bank that has a lot of small loans. So again, this comes into play with regional banks and not so much national banks. And then there's deteriorating financial ratios. This is when the ratios for a bank, whether that is the amount of debt that they have, the amount of liabilities they have, or any other number of ratios, start to get out of whack. And those can be an indication that there are problems ahead for an institution. It's not a guarantee, because right now in the US, we're seeing the ratios of pretty much every bank in the country get worse, but that's largely to do with economic conditions. And for the most part, the banks have prepared for the inevitable issues that could potentially come, whether that's creating loan loss reserves or that's hedging their bets in case they do have a run on the bank. Now, the nice thing about the financial ratios is if you take a look at something called the Uniform Bank Performance Report, which is released annually for each bank, you can actually pull out these ratios in a summary of ratios. And as you can see here, again, they are pretty complicated, but there's some nice features in these reports that kind of show the trends with respect to those ratios. It also shows you what your bank's ratios are relative to the other banks in their performance group. So if your bank's ratios are way out of line with the other similar banks to them, well, that could be an indication that you don't want to have your deposits there, or it could be an indication that you just need to pay attention to what's happening with them. Now, when it comes to looking at these ratios, you need to understand that deteriorating financial ratios may tell a story, but they also may not be significant. So looking at any one financial ratio at a bank and going, that's way out of whack, and going, it's going to fail, is not the right mindset. It might be something to pay attention to, but it doesn't necessarily mean just because one ratio got out of whack that there's going to be a failure. But there are things to watch out for that could be more indicative of a bank failure. Things like deposit migrations, lots of deposits leaving the bank all of a sudden, like what happened with SVB. Or you may see things like delayed financial reporting. So in other words, a Form 10K or a Form 10Q not coming out when it was supposed to. This also happened with SVB. Then there's the less obvious things that could just be a change in business practices, but could also be an indication of trouble ahead. Things like downsizing, closing branches, mass layoffs. There could be cuts in services or increased fees, or there could be, like in the case of SVB, unexplained capital raises. This is when SVB sought to raise significant capital in order to make up for those potential issues that they had with their long-term bonds. Now, by the way, a note here on SVB is those long-term bonds had gone down in value in the event that they needed to sell them. However, if they had not been put in a position where they needed to sell them, they would have come to maturity and they would have received all of the money back that they had originally invested. It was in that moment where they all of a sudden found themselves needing to liquidate an asset that was not an asset that was easily liquidatable, that they found themselves in a problem. And when those problems arise, there are some protections in place. So when a bank fails, typically what happens is the FDIC, assuming they're FDIC insured, will come in and they will take over the bank. And their role at that moment is to solve the problem in the most cost-effective way possible. What this could mean is that they will sell the bank in its entirety to another bank and fund any of the potential losses. It could mean they sell bank assets like the loans and the other things like the treasury bonds that they have in place. And at that point in time, if there is a difference in the amount of money that they have to pay out depositors and the amount that they actually have on hand, the FDIC will step in and they will reimburse depositors by up to $250,000 based on a whole bunch of criteria, which I'll get to in a minute. In some cases, like in the case of SVB, they'll actually fund more than that if there's extenuating circumstances. And with SVB, yes, there was extenuating circumstances. If a whole bunch of people would have lost, or a whole bunch of companies would have lost a whole bunch of money, well, that could have created a landslide in the banking system where pretty much all banks were at risk because of sentiment with respect to the entire financial and banking system. So obviously, the FDIC, the federal government, didn't want that to be an issue. They backed the whole thing, and arguably, they saved the economy as a result. And that brings us to the protections that are in place to protect people like you and I. Now, if you're not in the US, there are similar sorts of protections in most of the major countries in the world. So, what you need to do is go and research the country that you're in, figure out what the protections are that are in place for you, and then make sure you follow the steps, which I'm about to outline, in order to protect yourself. Now, with respect to FDIC insurance, there's a $250,000 per depositor per FDIC insured bank for each account ownership category. So, in other words, if you're a depositor and you've got more than $250,000, but it's spread out evenly over a bunch of different banks, and none of your deposits exceed that $250,000, well, you're protected. You're diversifying your deposits to multiple banks, and that will protect you so that you're under the FDIC insured limits. Now, the ownership categories include things like single accounts and joint accounts. So, in other words, if you've got a single account and you've got a joint account with somebody else or another corporation, both of those accounts will be covered. Then there are certain things like retirement accounts, trust accounts, employee benefit plan accounts, corporation, partnership, unincorporated association accounts, and government accounts that are all covered separately. So if you've got one of each of these category of accounts, you're covered for $250,000 for each of them. Now, this obviously covers deposits, but there's also other things that are covered in other ways. For example, there's SIPC protection, Securities Investor Protection Corporation. So if you not only have deposits with your bank, but you also have securities that are held by that bank or that brokerage, there's also coverage for the actual securities themselves. And SIPC protects against the loss of cash and securities at failed brokerages up to $500,000. Now, this protection is used when assets go missing. So let's say there's fraud, or let's say there's accounting errors. That is when this comes into play, because one of the things about securities is that you don't actually have to worry about them as much as you have to worry about your deposits, because typically the securities are held in trust for you. And if a brokerage were to fail, as long as those securities still exist and they haven't done something fraudulent like sell them out from underneath you, well, those securities will just be transferred from the failed brokerage to either a new brokerage or back to you in some way, shape, or form. Now, with FDIC insurance, it can take 2 to 3 days to get your money back. With SIPC, it can take a little bit longer than that as they go through the process of tracking down the actual securities. The big problem with this is if it takes a little bit longer and the value of the securities go down, well, you're at a loss because you weren't able to sell them because you didn't actually have possession of them in an account that gave you the ability to get rid of them. So when it comes to your securities, there's less to actually worry about unless it takes some time to get your securities back and there's been an economic crisis and a fall in the values of your stocks, which makes it kind of worrisome. So a best practice is to have multiple different brokerage accounts and keep some of your securities in one, some of your securities in another, so that you're protected in the event that one of your brokerages fails. Now, that leads us to how to protect yourself in the event of a bank failure. So the first thing you need to do is you need to confirm that your bank is actually FDIC insured. Now, there's been a whole bunch of news recently about a bank called Yotto, which it turns out wasn't actually a bank. They were taking funds, but they were actually holding them as deposits at an actual bank. But on their website, it often indicated that they had FDIC insurance. But the organization itself, Yotto, wasn't actually FDIC insured. The bank where the money was being held was FDIC insured. And when the link between Yotto and that bank went down, well, the bank froze the funds because they lost the ability to track where things were. And that's the sort of issue that could take a significant amount of time to sort out, especially considering that in the case of an organization like Yotto, the FDIC doesn't actually step in because there was nothing to protect because they didn't actually hold the deposits. So most of those people will likely get their money back, but it could take some time, which is problematic when they have mortgage payments and credit card payments and bills to pay. So confirming that your bank is FDIC insured is the very first step that you need to take. Then if you have a brokerage account, you need to also make sure that they're SIPC insured so that your assets, your securities are also protected in the event that the brokerage fails. Now, when it comes to your deposits, you want to limit your deposits to no more than $250,000 per institution per type of account. If you happen to be lucky enough to have more than that on deposit with a bank, It makes a ton of sense to diversify your banking and take some of your deposits elsewhere. And this is especially true if you run a small business or a medium sized business and you're putting all of your money into bank accounts for your operations. In fact, best practice for a business is to make sure that you have your money in multiple banks so that if for whatever reason you lose access to your bank accounts at one bank, you can still pay your staff and pay all of your operation costs from the other bank. And this is a lesson I personally learned the hard way when the bank system at the bank that I deal with went down and I wasn't able to make the payroll and pay my employees on time because I simply wasn't able to access my accounts. Now, my money was all there, the bank didn't fail, but one little glitch led to a whole bunch of people who relied on me to make sure that they got paid, not actually getting paid. Of course, they got paid, they just didn't get paid on time. Now we have multiple bank accounts at multiple institutions so that that same issue will never happen again. Then it's probably also a good practice to monitor your bank's credit rating. And if you go and you take a look at Moody's or you take a look at whatever credit rating agency and you see that your bank isn't really rated the best and that there's potential issues there, well, again, it might make sense to diversify your assets out of that bank or move them completely. Now, like I said before, I'm a believer in diversification, so I probably wouldn't move all of the money, but I definitely move a portion of it to make sure that I am protected if my bank isn't AAA grade rated. Then there's also the difference between dealing with small banks and big banks. If you're dealing with a large national lender, they likely have better management in place, and they've likely taken steps to minimize risk, both for themselves and for you. So dealing with a larger bank is often a really good idea, especially if you are dealing with just a small regional bank that doesn't have a lot of assets, doesn't have a lot of deposits, and could be at risk in the event of an economic crisis. Again, SVB. Now, if you do find yourself in a situation where you hear that your bank is in trouble, the most important thing you can do is remain calm. I'm not saying don't take action, but remain calm, knowing that you've got the full backing of the federal government to ensure your deposits up to $250,000 and sometimes more. But that doesn't mean that you shouldn't be going and pulling money out if you hear that your bank is in trouble in order to move it to greener pastures or a safer place. Take the steps necessary to move your money, but if you find out that your bank accounts are frozen for whatever reason, don't panic. Understand that the FDIC will likely step in, and within a week, you'll probably be able to get all of your money back out. Oh, and one last thing, because I remember this clearly from 2008. When a bank fails, don't assume that your debts are going to be forgiven because the bank went out of business, because your loans are an asset of that bank. And when the FDIC steps in, they will, in fact, take those assets and sell them to another bank or sell the bank in its entirety. In 2008, when all the banks failed, everyone thought, great, I'm never going to have to pay my mortgage again, only to find out that they got letterhead the following week from a different bank stating that the account had been moved and that the payments would continue as they did previously. So don't be foolish and stop making your mortgage payments just because your bank went under. There's a good chance that you're going to have to make them anyways, because debt is one of those things like death and taxes that just doesn't go away unless you pay it back. Once you have it, it is in fact more or less a certainty that you're going to have to pay it. There's no such thing as a debt jubilee, and in all likelihood, there never will be. Now, that being said, this brings up a whole bunch of questions about a whole bunch of different things, including the national debt and all the issues surrounding that. And if you want to see another video where I talk about the national debt and how the US is going to try to inflate it away potentially, and how you can too by being strategic, make sure you check out this video right here.